Thanks, John, and thanks, Marine Money, for having us today. Today, we want to discuss the unprecedented events or black swans the marine industry has experienced over the past couple of months. Next slide. To navigate through this, I think it's first important to discuss the landscape of post-COVID market, both domestically and internationally, and then how that market is currently reacting to the COVID and oil price reductions. And more importantly, kind of where we expect going forward. We'll also leave some time at the end for some questions. Next slide. One more. So we'll start with the U.S. So the state of the market here pre-COVID was a bullish market. The market each year was slowly recovering from the 2015 oil market crash. Our terminal operators were coming off record years, especially in the bulk stevedoring sector, although stevedores were expecting some headwinds due to the tariffs imposed by the U.S. government. Shipbuilding was starting to see some resurgence with repair work and limited activations of some oil rigs. Also, they were really thriving on federal work. To tug and barge sector, we're seeing some consolidations of smaller fleets, but the day rates were staying stable, and talks of some recessions just weren't materializing. Just as a tug and barge, we also saw the consolidations of the offshore fleet. In this particular industry, it had an older, overbuilt fleet complement, which was hit hard during the oil downturn. It seemed as if the correction process was beginning to take shape, but and was projecting to be a profitable year for the well-capitalized and well-run companies. You know, unfortunately, with the insurance market prior to COVID-19 pandemic, insurers were looking at a hardening insurance market. It was estimated that the global marine insurance market was going to grow about $8.42 billion US dollars over the next 4 years. So my colleague will touch on what's going on and what's happening in London pre-COVID, but domestically here, we were entering that hardened market, especially true on hull, auto, and bumper chutes. While domestically, we had seen the addition of some great new capacity, such as Ascot, we also lost some really large players, Allianz, Catlin XL, and P&I, and also the merger of Navigators and Hartford. Next slide.
Thank you, Hardie. Yeah, the international market, well, it's very much inextricably linked also to the American market and obviously global markets. It's a bit of a cliche, but shipping represents 90% of everything that's shipped on Earth. So the interaction between ships and the global economy is absolutely intimate. So if the global economy hiccups, then shipping gets a cold. So when we were pre-COVID, I don't think any ship owner has ever admitted to saying times are good. The times were reasonably good for a number of them. At the time, there's about 100,000 ships trading in the world. That means there's overcapacity, but capacity had grown up by about 3% year on year. There's been some consolidation in the container sector, with 10 lines representing around about 90% of the container trade. But that, relatively speaking, was thriving. The passenger sector continued. That's passengers in terms of people who need to go from one place to another for purposes of work or other reasons, as opposed to the leisure industry, which is the cruise industry, which was also thriving as it looked to widen its demographic from the typically retired and elder cruise passenger to a wider and younger audience. Gas was thriving as well. Whilst on the other side of things, I guess the struggling sectors might have included the offshore side, which Hardie's referenced, with low oil prices at the time, and the beginning of the price war and even lower oil prices, a lot of that sector was finding it difficult to survive, and we've seen some fairly well publicized failures in that sector. But generally speaking, from a shipping point of view, things were good. And that was also, relatively speaking, the same on the insurance side of things. in the sense that claims still were relatively low. Nevertheless, various factors were driving a harder market. The marine insurance market, and here I'm talking about the commercial market, it has for some time failed to write at an underwriting profit. And we saw in 2019 and at the beginning of 2020 some fairly hard actions being taken as capacity removed itself from the market, and so demand outstripped supply and prices started to go up. And similarly, in my particular specialist field, which is protection and indemnity, which is the third-party liabilities that arise out of ship owning, which is largely placed in mutual P&I clubs, that too, although claims were benign, relatively speaking, had underrated its product for some time. And again, following the commercial market to an extent, but not so extremely, that market was increasing its prices. So on a general basis, global shipping and global trade was reasonably buoyant, with one or two exceptions. And the downside, I guess, for ship owners in terms of their operating expenses were that they were starting to face increases in the cost of their insurances. Next. And next.
So during COVID, so unfortunately the maritime industry, from global ocean-going shipping to domestic inland brown water transportation and offshore energy, have been and will continue to be profoundly affected by the black swans. Because of the nature of the industry, which the mobility and intertransnational movement of people and goods, perhaps it'll be affected more than other industries. Maritime operators continue to be deemed essential, which is good for all of us in the world. This allows trade to continue, but it does put stress on the management teams within the maritime companies on how, when, where they will operate. First, we can start with the offshore sector. You know, unfortunately, oil prices have been crushed by a combination of the reaction to COVID-19, but more importantly, the oil war between Russia and Saudi Arabia. With oil trading or lack thereof in the negative dollars, we're seeing rigs, vessels go idle, and drillers are already starting to some layoffs. We've already seen some majors as well as vessel owners implementing enhanced screenings before and during the boarding of vessels. Again, these costs of screenings are having to be picked up by the vessel operators. With our inland fleet, we're still seeing day rates stay steady. While tank owners are still getting their day rates, we're really seeing fleeting operators see a drop-off activity because barges just aren't moving as much as before. Also, those barge owners are choosing to push empty barges so they can self-perform many of their repair and cleaning as opposed to outsourcing that with work in the fleeting operations. Because vessels must continue to be manned, crew issues have arisen. Management is having to decide how to handle these crew changes in the midst of COVID-19 response. And just within the past weeks, we've had a couple of tugs here in New Orleans decontaminated because crew members tested positive for COVID-19. This again puts stress on the company, not only the cleaning of the vessel, but keeping up the timeline and demands of the clients. And then obviously here in the US, the cruise ship and worldwide really, industry has been hit the hardest. Many are taking the opportunity to perform some maintenance, work on the vessels, but the huge amounts of cancellations and active cases remaining on the ships are causing a ton of trouble. And I'm sure we'll see some kind of government assistance or bailout, just as we expect with the airline industries. Next slide.
Yeah, international has many of the characteristics that Hardie's just described. I mean, firstly, the impact wasn't instantaneous. It took a little time to filter out, although, of course, it hasn't actually been a very long time since this virus proliferated. What happened was that people who were doing things and companies that needed things didn't need them, couldn't get them. Didn't require them. So whether that was infrastructure projects needing building materials, whether it was bulk commodities, whether it was the need for power and energy, demand just as a result of lockdown just started to fade away, leaving a situation which still is not fully filtered through. So we are starting to see now specific areas which are being dramatically affected. The first one, and most obviously, was the passenger sector. The cruise industry, much publicised issues with vessels having to be not allowed into port, and the passengers on board vessels which had the virus going through it. Along with the passenger trade, the ferry trade, people didn't need to go to work, people couldn't go to work, so the passenger trade very largely shut down. We have a client who runs over 350 passenger vessels, and not one single one of them is working at the moment because they can't. I think the instantaneous effect of something like the passenger and cruise industry is not necessarily being mirrored in other sectors. Things are continuing to sail around, things are being supplied, but the impact is now becoming more and more extreme. I was just looking at the BIMCO reports on the various ports around the world, and taking 150 or so nations, every single one of them has specific advice and requirements for a ship entering that port. Now, any ship owner travelling to a port has to make provision for that, and that provision not only means taking adequate security measures, but also preparing for delay. I think Hardie's already referenced the issue with crew, but on the international sector, that crew issue and crew change is even more extreme. And typically, say in the Philippines, crew contracts on a portal-to-portal basis, but they now have to be quarantined for up to 14 days prior to boarding the vessel, and for 14 days afterwards. And that costs money. There's day rates for the crew, and there's the cost of accommodation, all of which were extra expenses to those owners. And on top of that is the practical logistical issue of managing that whole issue. So the impact of shutdowns has been a real big headache for the practical application of shipping. And many ship owners now, without sufficient cargoes to warrant, if you like, their actual financial operation, are taking the decision to continue trading because it is effectively cheaper and more cost effective to run your vessels, albeit at slow steaming and with empty or half empty cargoes, than it is to put it into layup, which costs a lot of money to bring out of layup and the ship to be authorized to trade again. So the impact of shutdowns has largely at the moment, outside of the passenger and cruise sector, mostly been a slowing down of everything. On top of that, we have the energy demand thing and contango, and there we get into various black swans of coincidental events. So obviously the energy war had started, the price war had started. We go into contango, the forward pricing is higher than the current spot market. We have an issue therefore with a massive oversupply of product and a diminishing demand. I believe that energy demands globally are down by 30% in April, at a time when fuel has never been cheaper. And so at the moment, the issue for the oil industry and the ship owners that support it, on the tanker delivery side, they're in a slight unique situation where they have stopped largely trading the oil from ocean to ocean, from port to port, and are storing it, often at very high indeed day rates. This is a sort of artificial situation which will only unravel once prices start to ease up, but prices won't start to ease up until there is the demand. And at the moment, there is an excess of supply. And also, until COVID fully comes out of the system in every sense, people aren't needing to use so much power, whether it be individual consumers or the industries that require power to make their products or build things. So the international shutdown has impacted right across the energy sector, has had a strong effect on the contango situation that we're now in, and that also knocks on to the insurance implications that sit around that. The immediate insurance implications are complex. Firstly, as you will have seen, people are looking at their business interruption policies to see whether there is cover there, and in some cases there are already disputes as to the level of coverage. We're seeing restrictions being placed on coverage with COVID exclusions in certain commercial sectors. We're seeing all sorts of requirements for additional risk assessment, and we are also seeing a difficulty with claims, and that people can't go and survey the claims, can't adjust the claims, can't be on site to mitigate claims. So the insurance implications are also being driven out in a negative way at the moment through this COVID virus. Next.
Next slide. So now post-COVID, all post-COVID is still yet to be seen. As Stephen was discussing, it's a fluid situation. While it's believed in the second quarter results, the inland red flag fleet will remain profitable, the real question is, what happens the second half of the year? Traditionally, these operations make money if the refineries are making money. Because of the pre-committed purchase of the Saudi crude, it will be interesting to see what the U.S. majors do the second half of the year, given the oil prices. Also, we will see the resurgence of, the resurgence of COVID in the fall, just as the regular flu. I think the opportunity lies with those well-capitalized, well-run operations. Given the inherent struggle of the lesser, they'll struggle with this opportunity. More acquisitions we're probably going to see, and also see the bottom feeders go out of business. Unfortunately, with insurance, the hardening market's going to continue, not only pricing but terms and conditions. Stephen touched on it, where we are seeing carriers start to add restrictive language within the MEL, maritime employers liability policy, to exclude injuries related to COVID virus. Now, we successfully removed these exclusions, but it's something that we have to be on the lookout for. I think the key issue for the insureds and insurers alike will be to what extent policies respond where there's no physical damage. Given the prior years of the soft market conditions, there were extensions afforded for non-physical loss of cover into policy wordings. By example, extra expense or forwarding charges or access to property clause in the cargo policy may trigger coverage. In a hull, the loss of hire policy, it also may respond to vessels if they're quarantined or denied port entry. I think with the cruise lines, you may respond to a cruise vessel scheduled itinerary if it's directly impacted. The question being whether the quarantine restrictions, as opposed to the port closure, is sufficient for this purpose. I think none of these necessarily depend on any physical loss occurring. All these will have to play out and see how the carriers will react to the inevitable claims that are going to be reported. Next slide.
Yeah, following on from Hardie and talking of exclusions, one of the issues that I think international insurers are facing is the fact that these exclusions have been brought in, but at the moment there isn't the practical data to be able to understand properly the real long-term effect on claims from COVID. So we have exclusions, and the ability to remove them is being prejudiced by the fact that the insurance companies themselves don't really have the data to be able to understand how to rate or modify the exclusions that they currently have. This is something that is going to have an impact over the next year or two, and we're finding increasingly clients and prospective clients looking for insurers who are taking a more holistic view to or maybe even a long-term view towards the COVID virus thing. And here I'll make a distinction here between the commercial market and the P&I market. P&I market, being neutral, tends to look at risk in the long term and retroactively apply changes to their insuring conditions once they know the extent to which there is an unusual or additional risk. In other words, they don't impose exclusions unnecessarily just because there's a perceived threat. Whereas the commercial market needs to protect its balance sheet, and indeed its shareholders, needs to take an instantaneous decision in order to make sure that they're not about to hit a perfect storm of disaster. I wanted to talk very briefly about financial markets. Clearly, the stock market, the equity market, has been phenomenally volatile. And insurance companies and mutuals invest in those markets for their free capital and their free reserves. And those have taken an enormous hit, paper hit, admittedly. And whilst they are recovering, the volatility in the equity market is going to have a distinct impact on insurance companies and the returns they give to their shareholders, and indeed on the mutuals, in terms of the amount of capital that they have and are required to have under regulatory requirements. Now, I don't see that this is going to be a catastrophic issue at the moment, but it is absolutely unfeasible that with a volatile equity market, you cannot expect volatile insurance markets. Prices, as Hardie's already said, were going up before this COVID virus and will continue to go up. The insurance market at the moment isn't really paying a lot of claims because the claims have yet properly to be presented. Nobody really knows the quantification of how much those claims ultimately will cost. I've heard variations going from the very, very small and minor to absolutely catastrophic. Somewhere we'll know the answer in due course, but the only way insurance markets can deal with rising claims or downturn in their investment income is unfortunately by increasing prices. And I think we will see a steady increase in prices, even though there possibly isn't in the short term the claims activity to support that. Next.
So right now, first look at losses, kind of what Stephen had discussed. We really aren't seeing much coming in. Obviously, the projected GDP decline globally is going to hit the market pretty tight. We don't know what the losses are going to be. So at this moment, it's only a best guess. So I think it's something we definitely need to keep our thumb on and look at what's going on. But I think this is an opportunity where your presentation to underwriters on how you're containing COVID, what your procedures are, I think is going to be overly important. And getting to know your underwriters personally, I think you'll really find those long-term relationships where that's really going to come into play. And I think your presentation to the underwriters is going to be really, really important right now. Any questions?
Yeah, all right. Well, thank you so much for that. So we do have a couple of questions that came in, and so everybody, if you have a question, now is the time to throw it into the text box at the bottom of your control panel. The first is, how are risks arising from the use of tankers as floating storage facilities affecting the P&I market?
How they're affecting them. I think it depends on which individual club within the market you talk to. I mean, the reduction in actual physical operational trade reduces the risk from an operational point of view, from a navigational point of view, but the aggregation of product and somebody else's product on your vessel creates potential for significant claims, but on a catastrophic rather than on a frequency basis. Again, I think generally speaking, people are looking at this as a sort of temporary aspect, and vessels have been used for storage for oil and indeed loads of other commodities for many years. So I don't see that there is a particular issue at the moment with this.
Great. Another question that came in was, does COVID show what changes are needed in the marine insurance industry? Oh, Hardie, I think you're muted.
There, can you repeat that one more time? Sorry about that.
Sorry. What does COVID show? Does COVID show the changes that are needed in the marine insurance industry?
I don't know if it's shown what's needed. It will be interesting to see how the carriers react. Will it be some kind of buyback? Will there be an exclusion and there'll have to be a buyback clause into it, just as EPLI years ago was included in the MGL policy, and then really the claims started happening where they actually moved the EPLI out. They excluded it, and you have to buy a completely separate policy. It's going to be really tough for, I think, markets to compete unless all of them do the COVID exclusion. The nice part about where Steven's talked about is right now the clubs don't have it. So I don't know if it's necessarily changed the insurance market, but there will be a reaction to it.
Yeah, can I just pick up on what Hardie said? I do think that if you're really cynical about these things do drive out and differentiate the good between the bad. And I think what is needed is an increasing focus on insurers, whether they be mutual or commercial, that really care about the relationships they have, that they're there for their clients. And I think that we're seeing at the moment one or two cases, insurers who possibly are letting themselves and, more importantly, their insureds down, are not reacting in a sympathetic way. So I think very much the relationships that Hardie talked about are two-way, and we want to see more companies and more P&I clubs that really care about the problems their insureds have.
Okay, that makes a lot of sense. Another question that came in is, do you see an increase in M&A within the next 18 months? And do you see a hardening of the pollution market?
Definitely, yes, more M&A. I think just with companies that are going to be struggling, the downturn, you're going to naturally see that happening. With the pollution market, it's interesting. Traditionally, it has always been, I wouldn't say underpriced, but it's cheaper cover. And with the losses, also it depends on how many of these insureds move out of the traditional U.S. pollution market into clubs where pollution is going to be covered under the clubs. That's going to be yet seen. I don't expect it to harden too much on the pollution market, but there's definitely going to be a ton of M&A we expect.
Okay. Well, then we have an interesting question about, how are insurers viewing the risk aggregation of passenger ships crammed into a small number of ports, particularly in Florida?
Shall I take that?
Sure.
I think there are two issues here. I mean, from a liability point of view, probably relieved that all the passengers are off and all the crew are off, and hopefully, therefore, the ships are being fully cleaned and made virus-free. I think from an aggregation point of view, on a physical damage side and the loss of the property itself, the cruise ship itself, aggregation is always a problem. But you can't just lay up a ship anywhere. I mean, there are tight restrictions on what you can and can't do. There are huge safety requirements to do so. I think that in any case, in the cruise sector, there is already passing aggregation in the sense that major cruise lines all visit the same ports often at the same time, and these are ships that are moving as opposed to ships that which are static and laid up. The aggregation risk is an issue, but I don't think it's as big an issue as if it were trading full of passengers who were liable to catch the virus, where there really is a significant exposure.
Got it. Will banks require COVID coverage? Thoughts?
That's good. I haven't thought of that one. What are your thoughts, Stephen?
Well, I mean, it is a good question. I mean, the lender, may well want to impose requirements. The COVID coverage and its availability is the key to it. If it's there, then I guess they can and possibly will, particularly in certain sectors, if they feel that sector is particularly prone to a COVID outbreak. And again, we go to the passenger and cruise sector. But if there isn't the coverage out there, then you can impose it as much as you like, but people can't comply with it.
I think what would be interesting too, I think what will react quicker than the banks will be MSAs for the majors. I think you might start seeing some language in that more sooner than you would see in the bank and lending industry.
Okay, that's great. Now you kind of spoke earlier about this, that you continue to talk about premiums rising, and I'm sure like the ship owners and ship managers in the world, or in the audience, are kind of shaking their heads at that. Is there any scenario in which you would see insurance costs decline?
Let me take that one first. I think let's just go to the mutual element of this, or the P&I clubs. I was going to say the word ironically, and it's probably right, but in fact, despite the fact there is at the moment an unquantified exposure for the additional quarantine expenses, which could be substantial, and possible litigation, which could be substantial, the slowdown in shipping equals quite naturally a reduction in claims. And on the mutual side, where despite a need to get prices up, they're not there to make a profit. They're not for-profit organisations. So we can see a flattening maybe of the price rises in the mutual sector, simply because there aren't the claims. And if they don't have the claims, then they don't need to charge anybody extra just because they've got an underwriting loss. So I think maybe there's early signs that the mutual system may be stable for the next year or so, despite the fact that last year they were trying to drive prices up, but that depended on a full level of shipping activity.
Okay. I'm sorry, Hardie, anything to add to that? Or all right. So we're kind of at the end of our time. We have maybe had time for 2 more quick questions. One of it is kind of a bigger picture question. Do you buy into the idea that this black swan, well, this bevy of black swans, will push the maritime and insurance industries into the next, into the next phase, kind of like the transition from steam over 100 years ago?
It's possible. I was thinking about this before this talk. I mean, I think that the advances in robotic shipping, which don't by their nature require crew, may well be pushed forward. So it would be possible also that, and it's been talked about, that we may be moving from an era of globalization and back to more localization, and 3D technology may mean that products can be produced effectively over the airways rather than having to be shipped by sea. But people are still going to need bulk products, which, as far as I'm aware, you cannot build a whole load of corn through a 3D machine. They're going to require infrastructure projects which can't be built on site. People are still going to want, we believe, to go on a cruise or take a passenger ferry to get to their place of work. So I guess with some elements of automation removing, if you like, the human element, and it's the human element that always causes the claims, we probably could see an evolution. But again, shipping doesn't live in isolation. It's entirely dependent on the world itself. And so as the world changes, shipping will change with it.
Yeah, and for the insurance companies themselves, I think it's going to be interesting when they look back at the time, how productive were they with not actually seeing each other? Lloyd's a great example. Well, I think the history of Lloyd's will always be face-to-face negotiations, but are they realizing more people can work from home, more people can work remotely? Will their footprint, will the carrier's footprint kind of shrink a little bit? And so that would be kind of interesting, is how the carriers respond to, were we productive in this, and how we can communicate with insureds, underwriters, and clients alike.
Great. So unfortunately, we've run out of time. There are a couple more questions that we're not going to be able to get to. But thank you, Hardie and Stephen, for taking us through this really, really critical topic. There was obviously a lot of interest from the audience in this one. And for the audience, I appreciate you guys hanging in there and sending in messages. This webinar will be available either later today or tomorrow morning on our website. So feel free to kind of check back there for that. We'll also send a follow-up email with contact details, so that if you have any other questions that I didn't get to, you can reach out directly to the good folks at Lockton. But yeah, so thank you very much for tuning in, and we will talk to you later.